In today's episode, we're breaking down the biggest moves in the market this week's economic data, Jerome Powell's latest remarks, and why Tesla might be setting up for a monster rally. If you're into market news, macro insights, and real trading talk, make sure to like this video, subscribe to the channel, and follow wherever you listen to podcasts. Now, let's get into it. Welcome back to Stonkcast, the market show for the average Joe. Whether you're a diamond-handed degenerate looking for the next 500% play or a more conservative swing trader or investor, we've got you covered. We tackle the latest market news, give our 2 cents, and maybe, just maybe, help you make some money along the way. I'm your host, as always, Brandon Shar. Happy Thursday, everybody. We are almost to the weekend. Let's jump right in. We've had a crazy week in the market. We've had a lot of data dropping, headlines dropping. Oh, and by the way, it seems as of right now, at least, the bulls are in control. Let's kick it off with a market recap. And folks, in case you didn't know, the market is officially green for the year. Yep, you heard that right. Despite all the turmoil and tariff news that we've had, we are actually green on the year. So let's take a look at the heat map for those on YouTube. Kind of a mixed bag, but overall, I guess you could say more green than red, so that's a good thing. Microsoft did not have a great day. NVIDIA basically unchanged. But if we take a look at the charts, right? So let's look at the S&P 500, SPX. Today it finished up 0.4%. And I got some levels marked out here, and we are just climbing. We are above the 200-day moving average. We actually gapped above it, which is massive. I have this level here at 59.05 marked out, and we actually closed above it today. So I'm looking to see some continuation of that tomorrow. We'll see how that goes. But folks, the market rally is seemingly intact right now. Now, you know, there's a chance that we might be running out of steam. I think that is fair to say. You know, might be due for a little pullback here soon, but as of right now, things just continue to climb higher. Let's take a look at the NASDAQ. The NASDAQ today as well, above the 200-day moving average, which is great to see. Technically, on a daily chart, we are starting to get into overbought territory. So might be due for a bit of a cool off here, but we continue to put higher highs in. So getting awfully close to that all-time high, at least on the NASDAQ here, and really the same for the S&P 500. I mean, we're not that far off from all-time highs, which just sounds crazy to say considering where we are coming from with the lows that we had in April with the tariff news and whatnot. We've had a very resilient market. Let's do a quick check-in on the VIX. So the VIX right now is still below 20 and closed at 17.83 today, down 4%, a little over 4%. So the VIX continues to drop as well. So we are getting back to more of a stable environment, at least according to the VIX. Might be due for a little pump up here on the VIX. Personally, I'm holding some VIX calls because, I mean, just take a look at this for those, you know, watching on YouTube. I mean, the VIX has just really come down. So, you know, stocks are, you know, I mean, the VIX isn't a stock, but you get the idea. Stocks are like rubber bands, right? They're going to revert to the mean if they go too far one way or another. And that's kind of my idea or thesis with, you know, VIX. So I think it would be fair to say that we are due for an uptick in that eventually. But as of right now, things look really good on that front. And part of the reason why things have been looking so good is due to some of the data that we've been getting in the markets of late. We had a big week this week as far as economic data, which we'll get into here in a second. But first, I just wanted to share this article here on CNBC. Stock futures are little changed after S&P 500 extends rally for a fourth day. So the rally continues, like I said. Much of the market's recent surge has been powered by a comeback in major technology names. Nvidia and Tesla are each up about 15% this week, while big tech giants Meta Platforms and Amazon have jumped 8% and 6% respectively. This week, the S&P 500 is up 4.5%. A 30 stock Dow has added more than 2%. I don't really think anybody cares about the Dow. But anyways, in case you do, 2% there. And the NASDAQ composite has climbed 6.6% week to date. Even as a temporary agreement between the U.S. and China has lifted sentiment this week, some major U.S. companies are issuing warnings about rising costs and a murky macroeconomic outlook. Walmart said on Thursday that it will likely have to raise prices on some items in late May due to tariffs. We're looking pretty good, and like I mentioned prior, due to some of the economic data that we've been getting. So first of all, we had CPI, which came out on Tuesday. According to CNBC, annual inflation rate hit 2.3% in April, less than expected and lowest since 2021. That sounds awesome. I've also seen some other reports that kind of spin the CPI number differently. So at the end of the day, folks, it just depends on where you're getting your information. People are going to spin, the same facts in different ways. But at least according to this, sounds pretty good. The consumer price index rose a seasonally adjusted 0.2% for the month, putting the 12-month inflation rate at 2.3%, its lowest since February 2021. So I always like when they throw in this chart every time we get a CPI report. For those on YouTube or, for those who are listening on Spotify or iTunes, basically looking at a U.S. consumer price index chart with the peak in 2022, which was at 9%, and it's just come down gradually over the past few years and currently sitting at 2.3% for all items CPI as of April. So looking pretty good. It continues to come down, which is awesome. Inflation was slightly lower than expected in April as President Donald Trump's tariffs just began hitting the slowing U.S. economy, according to a Labor Department report Tuesday. The Consumer Price Index, which measures the cost for a broad range of goods and services, rose a seasonally adjusted 0.2% for the month, putting the 12-month inflation rate 2.3%, lowest since February 2021. The monthly reading was in line with the Dow Jones consensus estimate, while the 12-month was a bit below the forecast for 2.4%. Excluding volatile food and energy prices, the core CPI also increased 0.2% for the month, while the year-over-year level was 2.8%, the forecast for 0.3% and 2.8% respectively. So CPI looked great. So we got that on Tuesday. And then just this morning, we actually had PPI data, so the producer price index, which looked pretty good as well. If you take a look here, core PPI year over year for April came right in line, 3.1%. Core PPI month over month for April, you got negative 0.4%, which is pretty interesting. The forecast, I believe, was 0.3, if I'm not mistaken. Yes. Was 0.3, came in at negative 0.4. Core retail sales, we also got that this morning as well, and that came in at 0.1%, projected 0.3%. So we had a lot going on, and then you also had jobless claims, which came in about as expected. So basically what you need to take away from this is very simply that we've had a lot of data this week. And based off of the data that we're getting, the market sees no reason to not continue the rally. We haven't gotten any kind of shocks on hard data. We haven't gotten anything that screams recession. And actually, funny enough, some of the banks that were putting out, I think Goldman Sachs put out a recession guide or expectation or probability, I should say, for the year at 60%, has since revised that. Which makes sense considering we're seeing the market seemingly just head to the moon now. So very funny how some people's opinions can so swiftly change. But As of right now, things are looking pretty good there. Of course, all eyes were on Jerome Powell to interpret this data. Here's what he had to say on the data. We actually heard him speak this morning. Right here, Fed's Powell cautions about higher long-term rates as supply shocks provide policy changes. Fed Chair Jerome Powell said Thursday that longer-term interest rates are likely to be higher as the economy changes and policy is in flux. He said, quote, "We may be entering a period of more frequent and potentially more persistent supply shocks, a difficult challenge for the economy and for central banks." He said at a policy conference, "The supply shocks remarks are similar to those Powell has delivered over the past several weeks, cautioning that policy changes could put the Fed in a difficult balancing act." So, based off of what he said this morning, didn't sound all that different from his prepared remarks and his press conference from the rate decision that came out last week. Basically, right now, as he said, we're in a situation where there's a lot of uncertainty around fiscal policy, and because of that, the Fed will continue to sit on their hands as it relates to interest rate hikes. Basically, right now, they're keeping the benchmark at 4.25 to 4.5%, and really sees no reason to change that overnight lending rate as of right now. That's basically what I got from his talk. So the market was pretty muted this morning related to Powell's talks. I think actually this morning, when you take into account the jobless claims, you take into account PPI, the futures markets were baking in that the S&P was going to open up down 0.5%. And then, obviously we finished the day, basically up 1%. So that was how we started the day. We had, Jerome Powell with his comments. And this is an interesting tool I want to make you aware of, the CME Fed Watch. If you're not familiar with it, it's basically a way to get a probability for when rate cuts are going to come. Now, I've said on the show in the past, we basically were projecting a rate cut over the summer, right? June, July, based off of how things are looking right now with the data and how Jerome Powell is talking. It seems that that projection for the rate cut is getting pushed out. So as you can see here, as of right now, the current rate is 4.25 to 4.5. If we're taking a look at the target rate probabilities, right, for July 30th Fed meeting, as of right now, there is a 61.4% chance that we stay exactly where we are. There's a 35.9% chance we do get a rate cut of 25 basis points and a 2.7% chance that we get real crazy and get a 50 basis point cut. So that's where we stand right now as far as probabilities for rate cuts. And this is a very cool tool as well. If you go to this probabilities tab, for those who are listening on iTunes or Spotify, basically looking at a visual chart layout for the projected dates in the future when we could see certain rate cuts. So basically, as of right now, it looks like you got about a 51.8% chance in September for a 25 basis point cut. And it looks like the chances that we get to 50 basis points cut from the rate really doesn't go up to any significant point, at least according to this website, till October at 39.2%. So as of right now, Jerome Powell really doesn't see a reason to raise rates. And I'll be honest, I can't really blame him. I know that, President Trump wants the rate cuts, but as of right now, the data coming in looks fine. So that's where we're at on that. You know what doesn't look fine though, folks? UnitedHealth. UnitedHealth has been getting beat up, and really for a while, ever since the assassination of its CEO back at the end of 2024. Look at this insane chart. I mean, this stock was as high as 600 back in early April, and as of today, closed at 274. Yep, you heard that right. the stock has been getting beat up. So let's take a look at why that might be. Found this article, Yahoo Finance, UnitedHealth stock sinks, touches 5-year low after new report reveals possible Medicare fraud probe. Well, that doesn't sound great. UnitedHealth Group stock fell as much as 17% Thursday and closed down over 11% lower, touching its lowest levels in 5 years and marking a more than 50% drop over the last month as negative headlines for the insurance giant continue to add up. Thursday's plunge follows a new report in the Wall Street Journal released late Wednesday that said the company is facing a criminal investigation related to possible Medicare fraud. In a statement on Wednesday, UnitedHealth called the story deeply irresponsible, referring to a supposed investigation. UnitedHealth added in its statement that it stands by the integrity of its Medicare Advantage program. Well, isn't that nice? On Tuesday, the company announced its former CEO, Stephen Hemsley, would replace Andrew Whitty, who had been CEO since 2021, in a surprise move that sent shares of the company down nearly 20%. The company also pulled its 2025 forecast and making the executive change. Wall Street analysts said following the leadership and forecast announcements, the company is unlikely to receive the benefit of the doubt from investors, until some semblance of stability can be offered. So not a great situation. I mean, this company has just been in the headlines for not great things for a while now. The company also suffered significant public backlash following the killing of former executive Brian Thompson in December, and investors are suing the company for downplaying the impact of that tragedy. That is interesting. So, there's a lot going on right now with this company. It's getting a lot of heat from investors. It's getting a lot of heat from the DOJ. And it's really not in a great spot right now. So I would not be touching this with a 10-foot pole personally. Congrats to anybody who, I guess, played puts on this. I think I was looking earlier. If you had 600 strikes on the put side for June 20th right now, you would have to pay a premium of about $32,000 for that, which is just absolutely insane. So anybody who got in before these giant moves down, congratulations. But yeah, something to definitely keep an eye on. This was something that was dragging the Dow down today. And, it put in, technically speaking today, it put in a bullish candle. It's extremely, extremely oversold. I mean, the RSI on this thing is 12 right now. Just as a point of reference, RSI being the relative strength index, is a way to gauge whether stock is overbought, oversold. And when you're looking at that indicator, typically an oversold territory is 30, and overbought territory is 70, right? So 30 on average is going to be an oversold area. And right now the RSI for UnitedHealth is sitting at 12. So very, very low, but obviously there's a lot going on with this company. So that's not great. How about we take a look at a stock that is doing pretty great? Tesla. Folks, this stock has been on a heater. Last episode, I called out the 290 level as something I was paying attention to see it, break above that. And boy, oh boy, did it. As of today, it closed at 342.82 and has definitely been on a tear. And just as a point of reference, if we're looking at the RSI for Tesla, this is technically in overbought territory, hitting that 70 threshold today. But it doesn't guarantee anything. I've seen stocks that are oversold stay oversold for a long time, and stocks that are overbought stay overbought for a long time. So, but with Tesla, I mean, this thing has just been cooking. And part of the reason it's been cooking is due to a lot of the short interest that this stock currently has right now. I think I saw a report that said something like $27 billion are currently bet against Tesla to the downside. And so basically, as this stock continues to climb, it's going to put more pressure, more heat, more pain on those betting against it, the shorts. And I mean, listen, I'm preaching to the choir here. I'm sure we all remember GameStop and what happened there. I'm not saying that's going to happen here, but it is definitely contributing to the upward momentum. It was also oversold, back in April. So Tesla looks very, very good right now. For me personally, I'm looking at a couple different levels. I think the big one I'm looking at right now is going to be 385. Basically, I use something called a Fibonacci retracement to kind of line out some potential levels based off of the 5-year weekly chart. And, this is one of the key levels. 5, you can see it respected it back here in January. And then once it broke through it, broke through it. And then you can see this other level at 322, how it respects it. So, Fibonacci levels, not to get sidetracked here. We can do an episode on that another time. I'm fairly, I wouldn't say completely new to it, but I've only been using it for a limited amount of time. But it is pretty wild to see how the Fibonacci levels are respected on the chart. So you can use them as points of support, resistance, can help you with your trade plan. But very simply put, I think we have more room on Tesla. We're sitting at 342. I think there's another $40 out of this thing to the upside before we get a pullback. We are above the 200-day, the 50-day, which is great to see. And I think that there's also a lot of big money betting on this as well. And so I think it definitely is worth paying attention to when you have big money on the same side. As far as Tesla's short interest, as of April 30th, Tesla has approximately 81.3 million shares sold short, representing about 2.90% of its public float. The short interest ratio, or days to cover, is 0.7, indicating it would take less than a day of average trading volume to cover all short positions. So the interesting thing is that Tesla's historical short percentage is somewhere between 2.7 and 2.9%. So we're on the high end of that right now, which is interesting. So if we continue to get some bullish momentum to the upside, we could see some pretty violent moves, as we've already seen over the past week or two. For me personally, I took on a Tesla swing today. I bought some 400 strikes expiring May 23rd. So we'll see how that goes. I'm obviously bullish on this name, but let me know, drop a comment. Let me know what you think about Tesla, what your opinion is on the Fed. Should they cut rates? Should they leave it? And thanks as always for watching. Just as a reminder, I will be back on Saturday for part 3 of the Intelligent Investor series. We will be taking the principles of Benjamin Graham as far as how he invested, and taking those principles from 80 years ago and updating them for today. So stay tuned for that. Make sure to like and subscribe. And then I will be back as always on Sunday for another episode, market breakdown, and see what we have to look forward to in the week ahead. We got one more day of trading. Let's see if we can close out green. Make sure to like and subscribe. Thanks as always, folks. And remember, plan the trade and trade the plan. Have a good night.